When it comes to trading, this is very, very powerful, and a lot of people overlook this because most traders come to the charts and they're trying to capture those massive, massive moves. However, you can make a lot more money trading much smaller moves if you know what you are looking for. So today I'm going to be talking about the importance of planning a trade that has a good risk to reward ratio. What is a risk to reward ratio? A risk to reward ratio is basically how much potential reward do you have for a trade versus how much potential risk do you have for a trade. Now, if we are trading a sideways range like this right here, we have a pretty clearly defined high and also a pretty clearly defined low. That means if we are going to put our stop loss under the lows and target the highs, you can see right here, if we come over to the prediction and management tools in TradingView, and we use that long position, when we hover our mouse over it, it says risk to reward ratio 4.58. What does this mean? This means this trade setup right here has 4 times more potential reward than it does risk. Now, this is so important because this means I could take 3 trades in a row, 3 of them could be losses, and then on that 4th trade, if it's a win, well, I've just made back all my losses plus a little bit more. Okay, this is very, very powerful when it comes to trading because it allows us to have a less than great win rate and still be profitable. Now, I like to trade very, very small time frames because what you can do is actually you can get very excellent, superb risk to reward ratio setups that can allow you to bank a lot of profit in a very short period of time with very, very minimal risk. Now, let me show you what I mean by that, okay? I'm currently in a trade right here. You can see I'm literally long from almost the exact bottom. Now, first of all, let's talk about how am I even long from the exact bottom. Well, it's simply just taking a Fibonacci tool from that last major low to the high, and you can see that the Fibonacci 618, the golden pocket, is literally right here. Okay, so what happened last night was we had this high that we had established right here, and we got a liquidity grab from that, which, by the way, was the last short trade setup that we gave in the Casper Crew VIP Discord. We were looking to basically take out that high with the bearish divergences, get a liquidity grab of that high, and then come back down into the range. And that is exactly what happened. By the way, shout out to the Casper Crew because I know you guys are absolutely destroying these charts. So then what I did is I pulled the fib from the low, that last low we had down here, to the high, and you can see that the Fibonacci golden pocket retest is coming in right around this area. What does this mean? This means that as the price is getting a move to the downside, we can now prepare for a trade setup that potentially has a very high risk-to-reward ratio. Let's take a look. If we go ahead and plan a long trade from the golden pocket, understanding that our stop loss, let's say we're really just trying to long that 618 Fibonacci, right? We're trying to long that 618 Fibonacci. Almost to the dang dollar. Basically, what this means is we can use a very tight stop loss, like 0.12%, and then let's say we want to target the top of this mini range right here. Basically, what this does is this gives us a 7-to-1, almost an 8-to-1 risk-reward trade setup, where if we're risking, let's say, 1% of our total account, we're potentially going to be making 8% of our account in only a 1% move. Now, why can I make so much money on a small move? Is it because I'm being very risky? No, it's actually because I'm using good risk management. Now, what a lot of people don't understand about trading is that regardless of whether you're shooting for a tiny move like this or a much larger move, let's say something like this. In fact, let's even drag this up even higher. Yeah, right about here, okay? Let's take these 2 trade setups as an example. Whether you're shooting for a tiny move like this or a big move like this, you should only ever be risking the same amount of money per trade. And for me, that's between 0.5 and 2% of your total trading stack per trade that you take, okay? So what does this mean? This means if we're shooting for a trade like this, we can put much more money on the trade than if we were shooting for a trade like this. Why? Because if I get stopped out of a 0.12% stop loss, or if I get stopped out of a 0.5% stop loss, I can basically put 5 times more money onto this trade than I would on this trade, and both of them would get stopped out with a 1% loss, right? If I'm risking 1% of my account, all we really need to worry about is that risk to reward ratio. If it says 5.2, that means I'm making 5.2 more reward on my take profit than my 1% risk. So if you're risking 1%, whatever this number says, this is the percent you're actually going to make on your account relative to how much you are risking. So if it's a 5-to-1 risk reward ratio and you're risking 2%, then you're actually going to be making 10% on your account and risking a 2% loss. Okay, so what this does is this allows us to put a lot more money on the trade and to realize a really good risk to reward ratio in a very small move. Now for me, I like to take half the trade out on a take profit 1. Now if you have a risk to reward ratio like this, okay, a 5-to-1 risk reward ratio, that means when you hit your take profit 1, you have just made 2.5% on your account, not including the fees. What that means is because you've made 2.5%, you could take that partial profit and then get stopped out of your entry and then take a loss and still be in net profit because you made 2% on that first take profit, stopped out of your entry, so it's a 2% gain on the trade. That second trade's a loss where you lose 1%. So for the day, you had one partial win and one loss, and you're still in profit for the day. Now, this is something that messes a lot of people up because I'm a huge proponent of taking profit, moving the stop loss to the entry, and then letting the trade play out. Well, if people are taking trade setups like this where they have a 1% stop loss and then they get a little nervous, right? And let's say they hit a take profit 1 right here and then get stopped out of their entry. Well, guess what? They made 1%, they made 0.5% literally on their account on that take profit 1. And then the next trade they take, let's say, that gets stopped out at a 1% loss, now they're negative 0.5%. Right, their wins are not outweighing their losses because they're not waiting for that first take profit to get hit. So whatever trade you're taking, you need to make sure if it's a stop loss of 0.5%, right, or if it's a stop loss of 1%, let's say, you need to make sure that when you're taking profits, that TP1 at least a 3-to-1 risk reward, preferably at least a 4-to-1 risk reward. If your stop loss is 1%, you need to make sure you're shooting for at least a 4% move to the upside if you're taking a long trade, okay? Now, of course, this involves understanding technical analysis because you need to understand where your trading idea is wrong, okay? If I'm taking a trade here on a small time frame where I'm literally looking to take a long trade from this exact level, that means if the price comes below this level, I'm wrong, and I need to get out of the trade right away and wait for the next trade. Okay, this is where I am invalidated on my trading idea, right? You need to know where you're invalidated in advance, right? A stop loss is not an arbitrary thing. Your stop loss exists so that you know when you're wrong, and your stop loss also exists so that you know how much to actually put on that trade. Okay, the way you're going to figure out how much to put on a trade is you're going to take the dollar amount that you are risking. Let's say if we have $1,000, we are going to risk $10, right? And then we're going to divide that by the percent of our stop loss, right? So if we have let's say a 1% stop loss, then what we do is we move the decimal point over 2 places, right? And we divide that by 0.1, right? The decimal point's over here. And then we move it over 2 places. We're dividing that by 0.1, right? So let's say we have a 0.01% stop loss, right? 0.01% stop loss. I mean, that's crazy, but we could move this decimal point over 2 places, and we would have over here, and then one more over here. That's crazy, but we could divide it by 0.001. So if we do 10 and divide that by 0.0001, that means we could put $100,000 on the trade and still only risk $10, right? So we're going to do dollar amount that we're risking divided by the percent of the stop loss. That equals our position size. And once we have that position size calculated, that's how much we can put on the trade. So if you have $1,000 in your account, if you have a 0.01% stop or whatever, or a 0.1% stop, you can put 10 or even 100 times more money. Of course, this is only if we're scalping extremely precise levels, but let's say, you know, a 0.1% stop, you can put 10 times more money than you actually have onto the trade and still only risk 1%, okay? Now, there are ways to scalp these very, very low time frames. You know, I've made a lot of content on how I scalp the 5-second time frame, but in general, this mindset will definitely help you become more profitable, because what it will do is it will allow you not only to make sure that your wins are outweighing your losses, but make sure that even if you're trading a small move, like less than a 1% move, you can still bank a decent profit instead of sitting there all day or all night or all week waiting for the price to move 10%. And then once you've locked in that TP1, you can let this thing ride. I mean, for me right now, my next target is actually going to be a new high here, which basically means, with half my position size now, a little bit, about half the position size right now, I've got myself, with my current position size, potentially making now 10% on the entire account. Now, I also want to say I'm not a proponent of keeping all your money on the same account, and I'm also not a proponent of using only one exchange, right? So I use multiple exchanges, multiple accounts, all these kinds of things, which it gets into, using higher leverage and things of this nature. But that goes beyond the scope of this video. But for right now, I just wanted to talk about the importance of having a good risk-to-reward ratio, using the proper position size, understanding when to take a profit so that you can lock in a win and then let the rest of the trade ride in case we actually go out into the stratosphere, which maybe Bitcoin is going to do. All right, guys, that is it for today's video. Make sure to like, subscribe, click the bell for notifications, because we are truly bringing you the juiciest trading strategy videos here on YouTube. God bless everybody. In the name of Jesus, Yeshua the Messiah, even if you are not religious, I still pray you and your family are super blessed. And I will see everybody in the next video. Peace.